Welcome to the Wealth Planning for the Modern Physician podcast, hosted by David Mandell, an attorney, author, and OJM Group partner. We share real-world financial lessons from physicians and insights from experts to impact your bottom line. Check the show notes to get a free copy of our newest book, Wealth Strategies for Today's Physician. Now, over to David.
Hello, this is Dave Mandell. Welcome to the episode today. I think we've got a really interesting topic and a very experienced expert on the topic. We're going to be talking about ESOPs, and probably many of you don't know what that means. And so we're going to dig into it, but there's a good applicability for medical practices. And that's why I wanted to have Bob on the program. So let me tell you about him, and then we'll jump into it. So Bob Goettling has 30 years of experience in the healthcare industry. He primarily focused on the transactional aspects of physicians' practices, ambulatory surgery centers, physician joint venture projects with health systems, private equity firms, and strategic buyers throughout the U.S. Since 2007, Bob has led the Bloom Organization's transaction services team. He is a licensed investment banker and securities principal, and also has a background in law, I think he'll tell us about. Bob's been instrumental to the Bloom Organization's M&A advisory group, which has become the leading physician sell-side advisory firm, closing over $10 billion in transactions. With that, Bob, welcome to the program.
Thank you, David.
Excellent. So I just read a brief piece of your bio. We're going to link to the full bio in the show notes, but give, the audience a little bit of just, more from out of your words, what you've been doing and how you came to get to know ESOPs.
Sure. So as same as you, David, I started out as a lawyer long time ago. Didn't last in it very long, and then back in the 90s, was one of the founders of one of the first practice management companies. Back that first round with physician consolidation, the FICOR and Med Partners back in the 90s. I was one of the founders of one of the ophthalmology ones. Led development there for about 10 years. Bought a whole bunch of practices, sold them back to the doctors. As a lot of those did. And then for about the last 21 years, have been, I call it, I jumped to the other side from buying physician practices, jumped over to working where I really think the value is created in helping the physicians figure out what to do, how to monetize, whether it be their practice, whether it be some of their ancillary businesses, their surgery centers. Bloom Organization, we made our name, 10, 15 years ago, doing more surgery center deals than everybody else combined. So it started in that. And then I've always, in the last probably 5, 6, 7 years, really, I've tried to specialize on the cutting edge stuff and where is it going? Because as you know, everything's always changing, especially in the doctor business. And so with what we're talking about today, ESOP is one of the things that I think is kind of the new horizon for docs and practices.
Yeah. So, I came across the ESOP concept in a totally other, context. I think it was regarding, some tax benefits and something else. But, so I know, it means employee stock ownership plan. That's correct? Okay. He's nodding his head for those of you listening. But beyond that, I'm pretty, pretty much at home plate here. And obviously most people listening and watching are physicians who don't have the background with an MBA or attorney or 30 years of experience that I have. And so, we talked about this before we went live. This is a complicated subject, but it's one that docs should know about because practices may be a good fit for this if they're looking in the M&A world. So we're going to try to keep this high level, benefits, costs, red flags, things that people should know about rather than getting deep into the weeds and the rule and the exception to the exception and all of that lawyers generally need to do. So let's start off with the basics. What is an ESOP?
Sure. So an ESOP is, as you said, it's an employee stock ownership plan. And it was actually created or invented back in the 50s, and but it never really took hold until the 70s. And it in the 70s, when the federal government, it made a decision that, hey, there's all these leveraged buyouts of companies happening. We would like to try to incentivize those types of deals that would really help the employees. Right. And so they created this idea, or this vehicle whereby a trust for the benefit of of your employees. A company can decide they want to pursue an ESOP and become an ESOP. And what that really is it's a leveraged buyout by this trust that's for the benefit of all the employees and the owners and the management of the company. And the government has given to make it more attractive, has put over the years, they've put several what I'll call economic, mostly tax advantages, but economic advantages to make it more attractive. And it seems to, every year there's more and more ESOPs, and there's probably a lot of companies that people don't. The big one that I always say is public supermarkets. A lot of people don't realize public supermarkets is an ESOP. United Airlines, once back when the airlines were having trouble, they did an ESOP. They made themselves into an ESOP. And again, as I said, there's a lot of good economic reasons and benefits for using it as a structure.
Got it. Yeah. I knew I was hoping you would come up with a couple of examples because I knew there were some companies that people just didn't realize. Publix is a good one that a lot of people recognize. And so thank you for that. So when did you start to see that this structure could be advantageous to medical practices?
Yeah.
Because that's, probably a fairly new development.
Very much so. So about 10 years ago, my partner and I, we were introduced to, and again, it's deal guys, right? We're investment bankers, and that's our expertise. We had introduced to the ESOP concept, and ended up, looking into it, doing the investigation, all the stuff right now that we're helping docs do. And we figured out, hey, this is a great idea. We want to do it for the Bloom organization. So we actually did it. It's going on 10 years, 9.5, 10 years ago. We did the transaction, became an ESOP. And as physician, advisors, while we were going through the process, and I think probably one of the tangential benefits that we saw to doing it was we looked at everything from physician practices, right? And we said, wow, this is great for us in the Bloom organization, but this could be incredible for physician practices. And so one of the first things we were going to do after we got done, after we became an ESOP and could say we were actually, one is take it out to all, a bunch of physician clients. And we did that. But what happened in the last 10 years is the reason it didn't catch on, and it didn't really catch on at all with physician practices, because it's very complicated.
Right.
And the same timing, 8, 9 years ago, the whole private equity and the MSO model came into, what I call the second round of physician consolidation, completely different from that in the 90s, but really took hold. And so as we would, over the last 10 years, as we presented, we'd always present the ESOP as an option. But our physician clients seemed like they were always going the private equity or the hospital or, the other different routes, and didn't really catch on. But then you fast forward to about 2 years ago when, and again, I think, as you know, David, at Bloom, we've done, I don't know if there's anybody who's done more physician practice, private equity deals than us all over the country over the last 6, 7, 8 years. We've done a bunch of them, but in the last couple of years, there's been some bad news, and, interest rates going up, making a leverage buyout for a PE firm, more difficult. But there's been a lot of wins, that have not really been helping the whole private equity from the physician consolidation and that standpoint. And so what I did is, being experts on the physician side, we went back to the experts on the ESOP, the guys who they're the most progressive and ESOP investment bankers in the country. Went back to them a couple of years ago And one of their partners, really, really smart, guy who lives and dies ESOPs like I do physician practices, really liked the idea. And he agreed, years ago when we said we thought this was going to be big. So he was like, I want to, let's try to put this together. So he and I focused on building what I'm going to call as a hybrid to the typical ESOP model that will work and will be, specifically engineered for physician practices. And so, we developed that model a couple of years ago. And sure enough, as a lot of the bad press and negativity was coming to the private equity deals, more and more physician practices have now been seeking us out saying, hey, what is this? I heard about this. Can you tell me more? How does it work? Is this something we should be interested in?
Yeah, that makes sense. I mean, first of all, again, I didn't know this before we talked, but the fact that you folks have done an ESOP for your own firm and 10 years in, I mean, that's just there's really there's no substitute for that. I always tell clients when they're becoming a OJM client, kind of come through our wealth process, and I'm advising them on the asset protection side, what I do, what I've done for myself, what I did for my parents, what I did for my brother's cardiologist. And that's what I'd want from a doc. If you were in this situation, what medicines would you take? Would you do this procedure or not, et cetera? So the fact that you can say you believed in the home cooking enough to do it, but not only that, now you're 10 years in, and I think you can say, hey, we probably could have done this a little better. And we didn't realize this was going to come up, but it has. But now we're 10 years into, we're going to use the analogy, the treatment plan on the ESOP. And so we can advise our clients, not only that we've done it, but, here's some things that we've learned. And so you can, do better. So I think that's a really powerful thing. And it does make sense that most people would go for the private equity check if they're looking to exit because it's just simple. Like, there's a check and then maybe there's a second bite of the apple. And, it's like, for some investors, the difference between a stock and a bond. People, a stock, they can understand, right? I own a piece of this company. A bond, is it par? Is it interest? Why does the value go down and up? A little more complicated. But they both have, really, obviously, important roles to play in a portfolio. Okay. So, and I think, talking, we've had on this podcast over, 5 seasons, docs who've sold their practice to a private equity firm a couple of years in, people who have gone down the road and, through a couple of LOIs, that not done it, attorneys, investment bankers, other folks. But there's, always been, and again, with so many physician clients at OJM, docs who've really never really wanted to go down that road or always skeptical or, et cetera. But, they didn't know what else is out there other than the old school of bringing a young doc in and, trying to take the practice over if it's a small practice or doing that in a larger role if it's a group. So, tell us, what goes on, just sort of the real basics if a practice becomes an ESOP, just, high level.
Sure. And before that, though,
Yeah.
David, interesting what you said about the clients, because I actually like to talk to docs who have done a private equity deal and are, a year and 2 years, 3 years in and not happy, because I really am interested in finding out, listening to them and finding out why. Right. Because that helps me. That
Right.
totally helps me in what I do. And what I found is there's two major buckets of reasons why they're not happy. And if you talk to them long enough and get into it, it'll be one or the other. And the first bucket is they didn't understand something. If I would have known this, I wouldn't have done it. Or if I would have known it was good, this was a risk, I wouldn't have done it. So there's that part, which is, again, to guys like you and me, very important, right? Because the key is we want to make sure that we're passing on to our clients the information, the pertinent information they need to make their decisions, right? And so I think that's very important. The second one, and probably even the bigger bucket on that, comes down to control. Right. They didn't want to, and no matter how the different deals are, I don't care if it's a hospital deal, a private equity deal or anything. If you look deep enough and you get the right legal counsels to advise you on it, somebody's not giving you a whole bunch of money unless they're taking control, right? And so even though in the business of physician practices, medical decisions, nobody wants the business folks, even, nobody wants to take that away from the doc, but that's sometimes is a misnomer as to what real control is, medical control and that. And so that second bucket of control. So really what's happened from the where the ESOP comes in is to target those groups and those physicians that didn't want to give up control. Right. There's a different answer for the ones that didn't know something. You can educate them properly and hopefully they'll make it the better decision. But for those that, and again, like I said, it's the bigger bucket. We didn't want to give up control, wanted to stay independent. That's what we hear. So those are all the ones now for an ESOP, because as I said, in an ESOP, you're basically selling the business, the practice, to a trust for the benefit of you, the doctor, and the employees. And so you never give up control. Nobody comes in, all the trustee cares about, who oversees the trust, all he cares about is that all the rules and regulations of ERISA, like for a
Right.
401k and all that, are followed. The trustee doesn't know anything about that, and that he's doing his job to look out to make sure that the beneficiaries of the trust, the employees and the doctors, are not being hoodwinked or anything. And so, but no objective, no trustee in an ESOP wants anything to do with running the business. And so, even from a board of directors perspective, it's exactly the same. However, what I tell the docs, however you're running your practice now, you run it the same way after you do an ESOP. Nobody's going to come in and try to tell you have to do anything different.
And so you had mentioned earlier, and this is, I think, how I was introduced to the concept, totally unrelated to what we're talking about today, was tax benefits. Like there were some reasons for businesses to do an ESOP, but I don't care, what kind of business it is. You want to sell, but you want some tax benefits out of it. I might have attended like a CLE lecture on it or something, and an ESOP was a way to do that. So give us, kind of high level, what are some of those tax benefits?
Yeah. And this is where it gets complicated.
Okay,
And so
so let's keep it real high level,
I
real
try
high.
to keep it very simple. So I try to when I'm talking to physicians, I try to break it down from the tax benefits and are the one of the, if not the major reason for doing this. Okay. And I put those into three basic buckets, and I'm going to oversimplify just to be able to make the point. Bucket number one is and that's basically the reason my partner and I did it. It's an opportunity to arbitrage ordinary income. Doctors right now, I don't care whether it's through ancillary income in a surgery center, through professional revenues through the practice, any money they put in their pocket at the end of the year is ordinary income. They're paying ordinary income tax rate. And in California, New York, and New Jersey, it's a lot of money, right? A lot of the dollar is going to that. Okay. So when you doing an ESOP, part of the reason you're selling, whether you do it through a note where you finance or go out and actually get financing for it, the proceeds you get, you're able to get them at capital gains tax treatment. So if you look at it as the same as in a private equity deal where you scrape some income, put it into an MSO and sell that, okay, the proceeds you get from that, you're able to get ordinary income, or capital gains treatment versus ordinary income.
Right.
Now you go then a second step, which is this is always falls into the category, and I make sure to caveat this before I say it. If something sounds too good to be true, it usually is. That beware that caveat out there. It goes into the second point. The second point on this is that if you take your proceeds and take them in cash, when you do the transaction, the sale transaction, just like you would at doing a private equity deal, and pay the capital gains tax. If you take a certain amount of those proceeds and invest them in something called a 1042, you defer 100% of taxes. So not even capital gains. So you're able to do a transaction and get all those proceeds and pay zero on the closing on taxes. So that and whether it's just an arbitrage from ordinary income to capital gains or going the 1042 route, it's extremely valuable. And if you look at it, like a lot of doctors do in doing a transaction where they say, okay, somebody's paying me 10 times, so I'm basically getting 10 years up front. And, but what if I work for more than 10 years? They always say, and that, but under that concept, the tax benefit is huge. All right. The third bucket. So those are the first two, very important. The third bucket, this is where sometimes it loses a lot of docs. If you think of a normal transaction where you had to go out and a leveraged buyout, right? In a leveraged buyout or a private equity transaction is the same way. For the amount of money that's paid to the doctors, you're going to go to a bank and borrow that money. So what does that mean? You got to pay back the bank, right? And so if you think in terms of, let's say you go to a bank, I'm just gonna make up a number and say you go to the bank and borrow $10 million. Okay. You're going to have to pay principal and interest on that 10 million, year one, year two, until the bank's paid off. Right. Well, under an ESOP, this is where the IRS in the 70s came in and they said, we're going to allow you, the ESOP as the owner here, to be a tax exempt entity, not have to pay any taxes. And so as a result, that $10 million that you borrowed, if you weren't an ESOP, you would have to pay in that $10 million. Let's say in year one, after you pay all your expenses, you have a cash flow of $1 million, right? Well, you want to pay the bank off as fast as possible. Well, as you know, you got to pay taxes first on that $1 million. And then with what's left over, let's say there's 600 grand left over, then you pay the bank 600 grand and it's going to take you, how many years to pay it off. Because you're a tax exempt entity, you're able to pay back the financing with pre-tax dollars. So the whole $1 million you're able to pay to the bank the first year, $1 million the second. So you're able to pay off the debt and the financing the bank a lot faster on an ESOP because you're using pre-tax money. Huge benefit that the IRS is granted only to ESOPs.
Yeah.
And then kind of corollary on that third bucket of being a tax exempt entity. If you think about it this way, and I tell practices this all the time, if you want to be in the M&A business and go out and buy the onesie twosie, groups around you, but you don't have the money and you don't want to go to the bank, as a tax exempt entity, it's much easier to go do in the M&A because you're able to use pre-tax money on doing it. So it helps from an acquisition perspective. But those are, I want to stay as high level, but those three buckets of tax benefits are so substantial that it really does differentiate itself from a physician group or even, any other type of a business. It differentiates from a value creation perspective, all those other types of models.
Yeah. And that was sort of my introduction to the concept years ago, that it was, a tax, sort of a really tax favored way to do a transaction if everything else lines up right. Right. And that's what you guys are helping people with. So I don't want to ask more follow-up questions on it because we're going to go down the road into more tax,
Right.
Because I know there's an ERISA element to it, all that kind of stuff. So, talk us through again, high level, I'm an owner of the practice. We've got, maybe other physician, employed docs. And then there's, the rank and file employees. If we do this kind of transaction, how does the ESOP impact the groups?
Great. Wow, David, that's a great question. And that's one that I've focused on a lot because in doing over all these years, hospital deals, private equity deals, all the different types of deals out there, right? What always seems to be the common denominator, the older you are as a doc, the better it is, right? And you often see practices that decide not to do a deal because the old guys, hey, they want their money. They don't have that many years to practice, but the young guys have a bunch of years and they don't want to, right? And so every deal that I've seen, like I said, I don't care what it is, it'll work for the senior guys. It doesn't necessarily, unless you specifically make a way to do it, it doesn't work for the mid-level guys, the younger guys, and the ones that haven't even joined, notwithstanding talking about the staff. right? So what we did with our partners on figuring this out is we used an element of the ESOP, and I don't want to get too crazy here, but it with this synthetic equity. We used that as as a way to create a hybrid that addressed each one of those categories. So not only does this work from a monetization perspective for the senior partners, it also works for the junior partners and for the employee docs and for the staff. And I'll even go you one step further that nobody would ever, be crazy enough to try to dig into. We've even made it work for the doctors who you've not even brought into the practice yet, who may, are still in training or in medical school or in high school, that are going to come down the path.
Or
Because
funds for future owners or something like that.
exactly, because as you know, the value in any physician practice, the long-term value is tomorrow, next year, 5 years from now, and those are going to be the docs that haven't even come in. So if you do a transaction where there's nothing in it for them, it's going to be hard to recruit, it's going to be hard to keep people and all that. So we specifically designed in this model of our this hybrid model of ESOP, a mechanism to benefit all those different groups.
That's interesting, and you and I will talk more about that offline, but that's important because I think it keeps people from doing a deal, and I think it also when a deal gets done, it's one of the reasons why it may not age well. Because 5 years later, the docs who really got the benefit are kind of on their way out. The ones who were like, okay, are like still there, and then the new docs are like, God, I don't want to be in part of this deal. So, um, so what we've been talking about practices. What size practice are we talking about? Is this something that the solo plastic surgeon who's listening or watching, it makes sense for them, or is it, do we need 10 orthopedic surgeons, or do we need like a super group? What size is kind of the sweet spot for this for considering this as an option?
Yeah, so the Department of Labor has some regulations as to you have to have a minimum number of employees. But
Okay.
any practice of 3, 4, 5 docs is going to be okay from that perspective. So that's not really, a minimum issue. However, what we found, and again, this comes more interestingly enough, David, this comes more wearing my ESOP hat, as somebody who's been in his company's
Yeah,
been
and
in
you've done it yourself.
than the investment banker trying to, that I don't think it's appropriate for a group that has less than 15 or 20 doctors.
Okay.
Now, again, that's not to say that a group of 10 doctors can't do an ESOP and be very successful. What I'm saying is that to do it right, to go through all the steps, the cost of doing it and everything, I think you have to have size higher than that. And so the number I've been using, that we've been pretty much using, is 15 to 20 docs. And so as a result, we're targeting, the larger practices. Doesn't matter the specialty, but the larger practices in the country. And that's only because, we want for our model and to make sure everything is done right, we think it needs to be bigger to make the economics really work for everyone.
Yeah, it makes sense. I mean, listen, every medicine has, its applicability. And, I didn't expect you to say, hey, this can work for everybody, right? Because it just, that's like, didn't you say something before about too good to be true, right? So, there's a sweet spot, and we need to know that. So speaking of that, what are some of the downsides? Like what would people come to you and say, hey, what should I be looking out for? Almost like we'll get to red flags in a minute, but what is the if we're going to use the analogy, the side effects of this medicine that we got to be concerned about?
Yeah. I mean, and the first one and the biggest one is the complexity. And as I said earlier, David, and this is I tell my doctor clients this all the time when we talk about ESOPs, that as a 1-year lawyer before I got out of that, as an
Yeah.
M&A guy, as a guy who does, you would think that I would get an ESOP pretty quick. In all honesty, and again, it was probably 2 or 3 years into our ESOP before I really understood all the way it worked in that. And by the way, physicians may never get to that level of understanding it. Okay. And because it's not appropriate, they don't need to understand it to that degree. But because you have the IRS who loves to come in and audit stuff, right? And they audit ESOPs to make sure, because remember all those tax things we talked about. They want to make sure that nobody's, everybody's staying within the lines and not going too far over what they've allowed. So you have the IRS involved, and you also have the Department of Labor. Department of Labor actually oversees ESOPs. That's part of their job. And so the complexities of both of those, and then let's add on all the normal complexities from a governmental perspective on physician practices, all the regulation, all the Stark and
It
the
doesn't go away. It's all
and the healthcare stuff. There's a lot of stuff, right? So those are the detail of it, and the understanding of it and everything is the toughest thing. And a lot of times I can now see when I'm talking to physician groups and everything, you know what? Yeah, this would be great, but we don't, we're not as hands-on enough to where this would be too big of a bite for us to try to chew off.
So
And so that's the biggest thing
yeah.
that I would say. And the second, from a negative perspective, or what can go wrong type of a thing, would be that, and this as well as I do in this business, a group of physicians can go to somebody who has never done an ESOP or never done a private equity deal and say, talk a good game and get them to put their trust in them to go forward, and they can really get them in a lot of trouble, right? That goes in spades here, especially with the Department of Labor and the IRS. You really do have to know what you're doing and do it right. And that doesn't just mean that you're even an ERISA lawyer. I'm sure you know plenty of those guys, as I do too. Most ERISA lawyers don't even understand the complexities of how to do, especially for something like a physician group or that, how to do an ESOP. And so it's very, very specialized and very important that you have the right folks, doing this for you, to keep you out of trouble.
So, and that makes a lot of sense to me. You had said the docs don't have to know how it works or all the complexities of it. It's like a watch, right? A lot of the people listening and watching probably have nice watches. They don't know exactly how it works. I mean, they know there's some spring in there and, et cetera, but it'd be hard to describe, how it worked completely, but it tells time and they have some basic idea of how it works. And I get that, but is this success factor to overcome that complexity? You need like one doc on the team who's really willing to dedicate? Do you need, and this gets back to the size of the practice. Do you need are you looking for a practice, not just 15, 20 docs, but we need that kind of size because we want there to be some professional manager of the practice, like a CEO or somebody who is a business thinker and is already running the practice and has the bandwidth to say, okay, I could take on the knowledge of a whole other structure in addition to the day-to-day and be able to explain that to, the owners in the practice, the docs, or is it that, they got to hire the right firm? Obviously, Bloom, this is what you guys do, or is, having the right key attorney. How do you overcome that, I guess is what I'm saying, because it sounds pretty daunting, even for a wealth management firm like us, where you got a CPA, an attorney and MBAs and all of this, like, oh man, there's a lot to take on. For a bunch of docs who are just like, just trying to keep up with their own specialty, I could see why it would be tough. So what's how have you seen practices overcome it, I guess?
Yeah. So, and I think there's two aspects of what, in that. The first aspect is I look for, in when we're presenting this, at first level, it's usually to a doc or to a CFO or to a CEO of a bigger group, right? We're presenting this to see if do you want to even find out more information to take it to that level? And then it takes different steps of bringing them in. And they don't know this, but what we're doing on the other side, while we're presenting to them and educating them on how an ESOP works and, all that, what we're looking at is we're looking at them and how do they have, how do they make decisions? How is the group run? Because as that's all over the board, right? And when you find a group, when we see a group that has a board, typically a physician board, right? But has good management, has a CEO, has a CFO, and the board acts like a real board of directors, right? They don't need to understand every detail, but they're presented to the big picture questions. They answer them, which determines the direction that things go, but they don't try to get into the details. That's the best setup for an ESOP. because it'll be the most efficient, and the docs on the board won't go crazy because they don't let themselves get mirrored into too much detail, right? So that's one thing that we look for that's ideal for an ESOP versus and it can be a big practice that has still one owner who micromanages everything. So, that can be a problem, right? The second bucket, though, of what you said there that I think is very important is the different, and I like to point this out all the time, that in a private equity deal, in a hospital deal, in another type of a transaction for a physician group, there may be reasons, or there should be reasons in addition to the economics for that, why they want to do it, right? I'll give you an example. We have terrible rates. We cannot, negotiate with anyone. We're terrible at being able to run the staff. We need help on this. We need help. We have never been able to capture our ancillaries. We need to be able to capture our ancillary. We need help on that. All those things can get you where outside help coming in can be very beneficial to the practice. In an ESOP, you don't have that, right? Because you're not selling to somebody who has that expertise. You're selling to yourself. And so either you better have it, because it's not going to, once you do the ESOP, appear the next day out of nowhere.
Right.
So you better have it, or you better have a plan for how you're going to bring it in. And so I think you got to look at both of those when you're trying to see from a physician group perspective, from our side, is this something that might work for you all?
Yeah, it sounds like, you look at the right practices are ones that are already, in pretty good shape. I mean, from a management point of view, from a strategic, they've got their answer, et cetera. And this is something that could take them over the top, or that could allow them to do something, but not the traditional sale, versus one that might be, we got a couple of, we have good docs, we do a good job of this, but we're not so business oriented. That's why, going into a larger M&A funded, platform might be good for us. And that's fine, right? This isn't meant for every single practice. This is, that's helpful. Last question. Obviously, this is something you guys do, but what should, if folks are interested or they go down the road, that they should be looking for in an advisory firm or in an attorney, or in some key professional, and what this other side of the coin is, what's a red flag that they should be looking out for, in that search?
Well, I know, and David, I know you and I are on the exact same page on this, with a strong belief, and this is whether it's a private equity deal, an ESOP, or anything, that getting the right counsel, and I'm not talking about legal counsel, financial and all that, is so very, very important. And to that end, it isn't, and I get myself in some trouble a lot of times, it's very rarely your brother-in-law, the accountant or the attorney. You need to go to somebody who does, this is all they do. And I will even say investment bankers that deal with physician practices, I don't believe that there are any that have done these, and you would really need to have several of them under your belt. I got the 1-2 punch. We do them and we are one, right? And still with that, David, we've partnered with the investment banking firm that does nothing but ESOPs. So that just is a way to show that it is very, very important to get. And that goes all the way down to the lawyers, to the, from the healthcare regulatory, to get the right counsel on that, because, the money you spend up front getting the right stuff will save you an awful lot of headaches down the road.
Yeah. Well, it sounds like, and given that, listen, we advise a lot of physicians, and client hasn't come to us yet and say, "Hey, what do you know about ESOPs?" That did not happen. This came from a professional setting, right? So it is, a subspecialty. I mean, I think that, this isn't, as opposed to, if anybody's watching or listening on just private equity deals, we're season 5, we probably had, 10 guests who on some side of it, either docs who've done it before, or, like I mentioned before, investment bankers or attorneys or private equity firms themselves, et cetera. But I haven't had anybody on ESOP. So that strikes me as, you've got to find advisors who have done this multiple times over, and that world's probably not that large. So really interesting. Maybe we'll be talking about this more and more. It sounds like, for the right clients. I go all the way back to my CLE course on ESOPs. I knew there were significant tax benefits, but I think this is really valuable. And obviously, we'll put Bob's contact information in the show notes. So anybody who's interested can reach out. So Bob, thank you so much for being on. I think it was really valuable.
Thank you, David.
And to everybody listening, if you found this valuable, feel free to subscribe, give us 5-star ratings if you're so inclined, leave us a nice comment, tell your colleagues and friends we're growing, and look for us in another 2 weeks, another new episode. Thank you.
The Wealth Planning for the Modern Physician podcast is brought to you by OJM Group, a multidisciplinary wealth management firm dedicated to helping physicians build and preserve their wealth while reducing taxes. Episodes from previous seasons are available on Apple Podcasts, Spotify, YouTube, and other popular platforms. Podcast listeners can get a free copy of our newest book, Wealth Strategies for Today's Physician. Simply text WPPOD to 844-418-1212 to request your free copy. Be sure to join David every 2 weeks for the newest episode of the Wealth Planning for the Modern Physician podcast. This podcast is being provided for informational purposes only. The ideas and opinions expressed on this show by Mr. Mandell and his guests do not constitute legal, tax, or investment advice or a recommendation of any particular security or strategy, and do not represent the opinions of the underwriters of this programming. Any information prepared from third-party sources is believed to be reliable, though its accuracy is not guaranteed. Opinions expressed in this commentary reflect subjective judgments of the speakers based on conditions at the time of recording and are subject to change without notice. Listeners should seek the input of their own financial, tax, and legal professionals before acting on any of the information provided.